I'm Christine Benz from Morningstar.com. I'm here at the Morningstar Investment Conference, and I'm joined today by Bill Bernstein. He's an author and he's an investment advisor. Bill, thank you so much for being here.
Once again, pleasure to be here, Christine.
I know, it seems like we do these interviews frequently. We appreciate it. Let's start with the current market environment. I think a lot of investors have been kind of looking at the market. Bond yields certainly aren't enticing. Cash yields are close to nothing. And equity valuations are not cheap either. So investors naturally are concerned about what they should do next, wonder what they should do next. You spend a fair amount of time thinking about asset allocation. What's your best counsel to them?
Well, I think you simply need to stay the course. You know, first and foremost, you have to have a strategy. You have to have a policy allocation. And you should, by and large, stick to that. If you're going to deviate from it, it shouldn't be by very much. And it should only be in response to very large changes in valuation, and of course in the opposite direction from those.
So let's talk about where we are currently in the context of market history over very long time periods. It does seem that we have been in this situation before. Let's talk about what tends to happen after market environments like the current one.
Well, you know, it's said that the four most dangerous words and the four most expensive ones in the English language are "this time it's different." And so if there really is something different now, it's that we're sitting at perhaps the tail end, or perhaps, you know, at the beginning of an even longer period of extended market valuations. The market has never had valuations this high for this long. So maybe this is, to borrow a fairly awful phrase, a new normal. It used to be you would see cheap valuations, you know, single digit 10, 11, 12 PE multiples maybe for periods of years and years at a time. We're still seeing those occasionally, but they don't last for 5 or 10 years. They last for 5 or 10 weeks now when they occur. So that suggests that returns going forward are going to be, in general, fairly low. And on top of that, of course, you have the situation with bonds where you have the central bank intervention, which is producing financial repression, essentially zero to negative real yields at most horizons. And that may not be something which is long-lasting. Eventually, the banks are going to have to, the central banks are going to have to unwind that, and we'll see higher yields.
So if there may be at some point some sort of market correction that would bring equity valuations down to a more attractive level, does that argue for maybe holding a little bit more cash than I otherwise would, so that I'm at least somewhat liquid in a position to take advantage of periodic opportunities?
You know, I think that you certainly should be holding more cash than you did, say, you know, 5 or 6 years ago in the wake of the 08-09 crash. And again, we're not talking very big changes, because that's generally not a good idea. But if you were, you know, 60-40 6 or 7 years ago, maybe you should be 55-45 now.
Okay. How about,
or not.
Or not. How about foreign equity valuations? Do you find that they're a little more attractive today, or not really?
Yeah, I do find foreign equity valuations more attractive. You know, you're seeing, it's not, you know, dividend yields in the range of 4 and 5%. It's not hard to find those, particularly in emerging markets. Of course, there's a good reason for those. Stocks don't get cheap without a good reason.
Alternatives, I know some investors have held out alternatives depending on whatever type, long, short, or market neutral, or managed futures, as a potential place to park money in the current environment of low bond yields and not cheap equity valuations. What's your take on alternatives?
They're a compensation scheme, not an asset class.
Because of their high fees, that completely erodes their return advantage.
And after all, what is, you know, an alternative? It's just some combination of stocks, bonds, cash, and commodities. You know, where's the juice in that? I don't get it.
When I'm thinking about putting together a portfolio, should it just be plain vanilla stocks, plain vanilla bonds, and call it a day? Is there any category that you think is interesting as a diversifier for those two?
Any time that anyone tells you that 60-40 is dead, or that any long-standing, well-established investment strategy is dead, that's usually the time to stick with it.
Okay, but 60-40 isn't the right allocation for everyone, certainly.
Correct.
Okay, younger investors should potentially have more.
Theoretically, yes.
Okay, I know in your book, though, you suggested that perhaps younger investors start out with lower equity allocations than 95 or 100%, just to make sure that they're comfortable with equities before they go in fully.
Yeah, if I've learned one thing in the past 10 or 15 years, it's that it's nonsensical to talk about the riskiness of stocks without talking about the investor who's investing in them. So if the investor is a young saver, they want volatility, they want low returns. Stocks really aren't all that risky for a young investor. On the other hand, if the person is in the decumulating phase, they're retired, they have no more savings, and stocks can be 3 Mile Island toxic, particularly if they have a high burn rate.
Okay. Bill, thank you so much for being here. Always great to hear your insights.
My pleasure.